Hello and welcome to this video. This video is about the capital asset pricing model that was introduced by Sharp, Lindner and Mossin in the 70s. For this video I planned the following. First of all, I would like to give an intuitive idea about what the capital asset pricing model is about. Then I would like to repeat covariances and correlations, whose are the key to understand diversification. I already did that in another video, nevertheless, I need to repeat it here. Then I would like to go into the correlation coefficients. Then I would like to apply correlation coefficients and covariances for a two-asset portfolio to extend it to a multi-asset portfolio then. I'd like to make a little excursus to utility theory and portfolio choice then. Later on I'm going to make an excursus to utility theory and portfolio optimization. Then I would like to do the portfolio optimization in a multi-asset portfolio. Then I'm going to measure the systematic risk, and this is where the beta factor comes into play. Last but not least, I'm going to mix a portfolio with a riskless asset to derive the capital market line and the security market line. I will end this video with a few key takeaways. Let's start with the intuition of the capital asset pricing model. The market pays investors for two services they provide. Of course, it's not the market, but it's the number of market participants. That's why market is here in a high comma. So the first service is for surrendering their capital and foregoing current consumption. So the market pays the time value of money, the interest. And second, sharing the total risk of the economy, because every market participant takes a certain risk in his portfolio. He's gotten paid by a risk premium whose size depends on the share of total risk he takes or you take. Now, the basic idea is that there is something like a market portfolio, which is then a reference for measuring the risk. How we measure risk, as volatility, as standard deviation or variance of the return, I have additional videos on that. I guess you have seen them already. If not, please refer to these videos. So we need a reference for measuring risk, and we have to choose the total risk the market has to divide. So we have a market portfolio as a reference. And this market portfolio is then defined to have 1 unit of risk. So the variance of this market portfolio should be 1. Other assets are then evaluated relative to this definition of 1 unit of risk. Now, what is the beta, or what will the beta be? The hard part is to show that any asset's contribution to the total risk of the economy or variance of the returns of the market portfolio M is determined not by the variance of the individual share, but rather with a covariance between them. So we need to standardize the covariance between the single stock returns and the market returns, so that we measure the risk of each asset relative to our definition of 1 unit, and we got the beta, because the beta of the individual asset is the covariance that we wanted to standardize, and we standardize it by the variance of the market. So covariance of the individual stock and the market divided by the variance of the market. The number of units of risk for asset I is then beta I. When we are concerned with only one asset, its risk and return can be measured, as discussed, using expected return and variance of return. If there is more than one asset, so a portfolio can be formed, risk becomes more complex. Two types of risk for individual assets are the systematic risk and the non-systematic risk. You can see this down in this little chart. The risk of individual assets can be split into diversifiable, non-systematic, or idiosyncratic risk. These are all words for the same. And non-diversifiable, systematic, or market risks. These are all three words for the same. Diversifiable risk can be eliminated without cost by combining assets into portfolios. We simply have to split our money and invest into a portfolio rather than into one individual asset, and by diversification we get rid of this part of the risk. But we got stuck with this part of the risk. So one of the most important lessons in all of finance concerns the power of diversification. Part of the total risk of any asset can be diversified away, so its effect on portfolio risk is eliminated, without any loss in expected return, so without any cost. This also means that no compensation needs to be provided to investors for exposing their portfolios to this type of risk, because they can get rid of it. So why should the economy pay you to hold risk that you can get rid of for free, or which is not part of the aggregate risk that all agents must somehow share? This in turn implies that the risk-return relation is actually a systematic risk-return relation. Let's have a brief look into covariances and correlations, whose are the keys to understanding diversification. So, when thinking in terms of probability distributions, the covariance between the returns of two assets, let's call them A and B, equals the covariance of A and B, which is typically written with the Greek small cap letter sigma and AB in the index. So the covariance is given by, and this is written in terms of empirical data, so in terms of empirical seen returns, daily returns, for example. We have the sum sign, and we have the daily return of A at day t minus the average daily return times the return of B at day t minus the average daily return of B. Of course, if we calculate the covariance of A with A, this formula turns into the variance formula. Covariances are kind of difficult to interpret. Only the sign is really informative. But the correlation coefficient, rho, is a normalized version of the covariance given by rho A and B is the covariance of A and B divided by the variance of A times the variance of B. Now the correlation coefficients are standardized and the correlation will always lie between 1 and -1. A correlation of 1 implies that both stocks behave completely the same. So if one stock goes up by 1%, the other one will go up by 1%. If one stock is going down by 1%, the other one is going down by 1% too. A correlation of -1 implies exactly the opposite. So an opposite behavior. If stock A goes up by 1%, stock B will go down by 1%. You can use this behavior for hedging. So hedging is more or less complete or perfect diversification. A correlation of 0 means that there is no systematic co-behavior. Now the question is, can we use this for diversification effects too? Because we know that -1 is perfectly reverse correlation, and a correlation of 0, can this still be used for diversification purposes? The answer is yes, and we will see it next to no time. If we now make a mu sigma diagram, mu typically stands for the expected return and sigma stands for the standard deviation, we can put both assets into this graph. Asset B and asset A. Asset A seems to have a higher risk in terms of standard deviation, but also a higher return in terms of standard deviation than B, who has a lower risk in terms of standard deviation and a lower return in terms of return, of course. If we now split our money half-half, so we have half A and half B, we form a portfolio of both stocks. And this will be, for example, here. So any mixture between those two assets will be on this egg-shaped curve here, which is a parabola, but just lying on the side, turned by 90 degrees. And of course, we can find a so-called minimum variance portfolio, which inherits the minimum risk combination between both. And if we now take a look what would be if we had different correlation coefficients, we look at this picture. Again, here we have asset A, here we have asset B, and this was the last page situation, and that is indeed where rho, the correlation coefficient, is 0. If we have a correlation coefficient of 1, we have a linear relationship like this dotted line here. So any mixture between A and B in a portfolio will be somewhere on this dotted line, which does inherit no diversification effect because both stocks do exactly the same. We can't diversify. These two dotted lines, or this triangle here, is the situation where we have a row of -1. And a row of -1 is a perfect hedge, which means that with a certain mixture I can get rid of all risk. Because if asset B is going up by 1% and asset A is going down by 1%, I can find a mixture of both stocks where the risk is perfectly hedged. I don't have any risk at all anymore. But of course, at the stock market, these situations are impossible to find. Nevertheless, with derivative assets, we can find those situations. But even if rho is 0, if we don't see any correlation between those assets, we still have this egg-shaped curve, and we can find a minimum variance portfolio that minimizes the risk. And this portfolio is a lot better. It's dominant, mu sigma dominant, towards asset B. Why that? Because it has a higher expected return and a lower risk than asset B. So there's no way not to choose this mixture in favor of B. That doesn't make any sense. I would always go into this mixture rather than putting my money into asset B. This is just a look into the future. So for a multi-asset portfolio, these are, for example, the 30 DAX stocks. Here we see RWE, here we see Vonovia, here we see Bayersdorf, Deutsche Telekom, Henkel, and so on and so forth. Of course, we can calculate, and these are real numbers here, we can calculate such an egg-shaped curve too. That's still possible. Later on, I will indicate how to do that. So this egg-shaped curve also exists for multi-asset portfolios. If we stick with a two-asset portfolio, the portfolio variance is given by, and this is due to the Bionic formula, WA squared. W is the weight of A in the portfolio. I just remind you that we spoke of weights here too. So for example, this portfolio was half A, half B, so the weight is 0.5, half of it. So this would be 0.5 squared for A. Then we have the variance for A plus 0.5 for B squared, and the variance for B plus 2 times the weight of A, the weight of B, and the covariance. Since I can use rewrite the covariance with the covariance formula, I can also change the formula into this writing here. It's just this n that has changed with rho AB times sigma A and sigma B. The expected return on a portfolio is the weighted average of the expected returns on each asset. If WI is the proportion of the investment invested into asset I, then the expected return of the portfolio, which is often referred to as mu P, is given by the sum sign across WI, which are the weights, times the expected return of asset I, or, different writing again, WI times mu I. The variance of the portfolio's return is not so simple. It is given by sigma P squared, which is the variance, and we see two sum signs, which is always the sum across a table or a matrix, and that's across WI times WJ times the covariance of I and J. I just mentioned that it is a sum across the matrix. So let's say that this is the correlation matrix of a multi-asset portfolio, but only with two assets. So we see the variance of A and the variance of B, and of course we see the covariance of A and B and the covariance of B and A. By the way, the covariance of A and B is the same as the covariance of B and A. So the sum, this plus this plus this plus this, all of them weighted, of course, gives the portfolio variance. If we now extend this to 3 stocks, of course we have the variances on the main diagonal here, and we have all the covariances in all other cells of this matrix. And if we now further increase, this is n is 10, again with covariance being light green, and the variances on the main diagonal being not green, blue, dark blue. And we go to 20. Now, of course, we see which cells are becoming more important. In other words, the variances lose their weight and the covariances gain weight in this calculation. If we now put more and more and more securities or assets into our portfolio here on the x-axis, of course we see a diversification effect. So with the risk at the beginning, the risk is going down due to diversification, but it will not vanish. It will rather stop somewhere here or tend to the systematic or market risk that we can't diversify away. If we do this with a certain calculus with different correlation coefficients, of course, we can't diversify away. If we have a correlation of 1, we still stick with 100% risk. But as soon as we have positive but not perfect correlations, the diversification effect becomes better and better and better. Of course, this is true for the multi-asset portfolio too. And we can see a minimum variance portfolio in here too, exactly at the, let's say, is it the bottom, I don't know, the left-hand side of this X-shaped curve. Everything above the minimum variance portfolio, so this part of the X-shaped curve, is called the efficient frontier. The part below the minimum variance portfolio is not part of the efficient frontier, it's just part of mathematical calculus here. Why is this part the efficient frontier? Because these are efficient portfolios that can be made, that can be put together from all the stocks in here, just finding the right weights. But you can't get across this efficient frontier. This efficient frontier is combined by efficient portfolios, and all these efficient portfolios are mu sigma dominant. Mu sigma dominant means you won't find a portfolio that has the same risk and a better return, or the same return and a lower risk. So everything that is in this red-shaped area here, let's take a look at this efficient portfolio here. So everything in this red-shaped area here is dominated by this portfolio. Let's go along this line here. Everything, every combination or every stock on this line is dominated because the efficient portfolio has the same return but a lower risk. Now let's go along this line. Here, for example, we find Henkel. Henkel is dominated by this portfolio because it bears the same risk but at a higher rate of return. And all others, of course, are combinations of these two effects. That is what we call mu sigma dominance. And if we speak of mu sigma dominance, we must make an excursus into utility theory. Because if we assume that there are persons who decide on mu sigma, who are mu sigma deciders, they would have something like indifference curves. Indifference curves combine all those combinations of mu and sigma that are felt indifferent, that are felt the same, that bear the same utility. And that's why it's called utility theory. Of course, the further up and the further left, the better is the utility. So this utility curve is better than this one, and this utility curve is better than this one. But this curve does not touch any stock nor any point on the efficient frontier. But this curve does. So this is the last curve. Of course, there are also curves below, but this is the outmost curve that just touches the efficient frontier. So that person that inherits those utility curves here, those indifferent curves, would probably realize this portfolio because it gives him the best utility. Of course, someone else who has different utility curves, like this person here, would rather realize this portfolio because he likes more this combination of mu and sigma, this combination of risk and return. And now, of course, we are in the middle of what we call portfolio optimization. Portfolio optimization is about finding certain parts of this curve because, of course, it's an optimization, finding all the combinations of Vonovia, Henkel, Beiersdorf, Deutsche Telekom, and so on that make out those portfolios. So, portfolio optimization is finding the efficient frontier, even in more complex situation than this, of course. So, to find all dominant efficient portfolio combinations, a mathematical optimization is applied, and that is called portfolio optimization. I don't go into formula here. I will do a video on portfolio optimization in R. That can be easily done with some optimization algorithm. It can also be done in Excel. So you can minimize the portfolio risk at a given return. So the given return is a constraint here. Or you can maximize the portfolio's return at a given risk as a constraint. So the risk is a constraint, it is fixed, and you're looking for the maximum portfolio. There are a lot of mathematical tools like linear programming, quadratic programming, nonlinear programming, mixed integer programming, meta-heuristic methods, stochastic programming for multi-stage portfolio optimizations, copula-based methods, principal component-based methods, deterministic global optimizations, or genetic algorithms, all of them being applied in portfolio optimization. And of course, portfolio optimization is not a theory, it is practical doing in all investment funds worldwide, may it be in London, in Frankfurt, or in New York. Okay, so diversification reduces risk. If asset returns were uncorrelated on average, diversification could eliminate all risk. They're actually positively correlated on average. So diversification will reduce risk, but it will not remove all the risk. I just remind you on this one, when correlation was 0, the curve went down a lot and it strived against 0, but we don't have that. Normally we have correlations around 0.2, 5 and 0.5, so they're striving against something that is above 0. There are effectively two kinds of risk: diversifiable, non-systematic or idiosyncratic risks. They disappear well in diversified portfolios, and it disappears without cost, i.e., you need not sacrifice expected return to reduce this type of risk. But there's still non-diversifiable risk, that is systematic risk or market risk, which does not disappear in a well-diversified portfolio. You must trade expected returns for systematic risk, and level of systematic risk in a portfolio is an important choice for an individual. We know that the returns on different assets are positive correlated with each other on average. This suggests that economy-wide influences affect all assets, like the business cycle, inflation shocks, productivity shocks, interest rate changes, or major technological change. These are economic events that affect all assets. The risk associated with these events is systematic or system-wide and does not disappear in a well-diversified portfolio. Now the beta coefficient comes into play. The beta coefficient is the slope coefficient in an OLS regression of stock returns on market returns. So the beta of stock I is the covariance of stock I and the market divided by the variance of the market. Beta is a measure of sensitivity. It describes how strongly the stock return moves with the market return. Let us make an example. A stock with a beta of 2 will on average go up 20% if the market goes up 10% and vice versa. By definition, the market has a beta of 1. Accordingly, companies with a beta of larger than 1 react more sensitive towards economic shocks, like cyclicals, or companies with a beta of lower than 1 react less sensitive towards economic shocks, like non-cyclicals. So, let us make an example. Cyclicals, automobile producers. If we have an economic downturn and many people fear for their jobs and fear for their income, they will not go outside and buy a Mercedes-Benz. That's why automobile producers are cyclicals. They cannot sell their stuff in economic downturns. But still, even if people fear on their income, they will still eat some food, they will drink beverages, or take their medicine. That's why food, beverages, and pharmaceuticals are typically non-cyclicals. Okay, we estimate beta using a regression equation. In practice, generally use last 5 years of monthly data or 1 year on daily data. Some use weekly data, but these are typical usages of betas. Of course, some companies publish beta estimates on a regular basis, like Refinitiv Icon that we use at the university, Bloomberg, and S&P. But what can we do if the company is not publicly traded and most business valuations will be based on beta, but most business valuation will value not publicly traded companies? Of course, we can find a comparable company or a peer group of companies that are traded. But we have to keep in mind that the beta that we measure by using OLS regression is determined by leverage. It needs some adjustment that we call releverage. We can also use accounting data like the ROE instead of the stock returns, but the accounting beta is discussed very controversial. There is no good indication that this has anything to do with a market beta. Or we can try to reason it out by a rule of thumb. Is it a cyclical company? Is it a non-cyclical company? What should it be? So reason it out would work probably better than accounting betas. So, what determines the beta? Companies with cyclical cash flows will tend to have higher betas. Higher operating leverage implies higher betas, but what is operating leverage? That is the ratio of fixed cost to variable cost. And, as I said, higher financial leverage also means a higher equity beta. If we now start mixing our portfolio with a riskless asset, there's just one choice that we can make. Let us assume we have a riskless asset here, like 20%. Okay, maybe a little high. Nevertheless, we take this as an example. So this is our riskless asset, and the interest rate here is 20%. And we can now mix this riskless asset with any of those shares or with any of those efficient portfolios. There's only one mixture that makes sense. And that's putting a line from here to the curve that is only tangential to this curve. And that efficient portfolio where this curve is tangent, or both curves are tangent, is what we call the market portfolio. And the line that we find doing so is called the capital market line. Why is this the only mixture that we should do? Because it is dominant, again, mu sigma dominant, towards all other combinations that are below the capital market line, and there is no individual point above it. So it is mu sigma dominant towards all other combinations. If the expectation of all market participants are identical, there's only one portfolio, the market portfolio M, that mixes with a riskless asset and dominates all other portfolios. Accordingly, all market participants will realize exactly this portfolio, and they will mix it with a riskless asset. The line between these points is called capital market line, or CML. If we now repeat our excursus into utility theory, we see our two persons with differently shaped indifference curves, and of course they now have to decide which point on this capital market line they would like to realize. The left one would rather realize this point, of course, and the right one would better realize this point. Since this is a mixture between the riskless asset and the market portfolio, roughly half-half, this person would put half of its money into bonds and half of its money into shares. There's a big issue for this guy because he is beyond the point M. Point M is here, but he is beyond. He has to borrow money to invest it into the market portfolio. He will not invest into bonds, but he will take credit to invest into M. From this capital market line, the security market line can be derived. Let us make intuitively. The risk-free assets earn the risk-free rate. So think of this as a rental rate on capital. This is just for borrowing money. And let us now take a look at this formula that we call the security market line. Don't mix it up with the capital market line that we have just seen. The security market line thus starts with RF, so with a risk-free rate. If the asset is risky, we need to add a premium, so the right part here is the premium. The size of the risk premium depends on the amount of systematic risk for the asset and the price per unit risk. The unit risk is, as we know, the beta of stock I. And the price for that is the market risk premium. Unsystematic risk does not add any premium, since the risk can be diversified away. If all funds are invested into the market, exactly the market risk premium Rm minus Rf, this part should be earned. The above formula is referred to as the security market line. So since this is the formula that we need to calculate everything we are looking for, like the cost of, since this is the expected rate of return for a certain company, this is the cost of equity. And what do we need to calculate it? Of course, we need an estimate of the risk-free interest rate, RF. So we can use something like the current yield on short-term treasury bills as one proxy. Practitioners tend to favor the current yield on longer-term treasury bonds. And, of course, remember to adjust the market risk premium, this part, accordingly, because there is RF inside too. You have already learned in another video about the yield curve, how to derive yield curve. If you haven't seen that video, please refer to it. So, of course, RF can be derived using the yield curve. We need an estimate of the market risk premium, so of this part. The expectations are not observable, but generally a historical estimate is used here. And of course we need a beta, so just run an OLS regression. The estimate of the market risk premium is still an open issue, of course. The market is defined as a portfolio of all wealth, including real estate, human capital, and so on and so forth. But in practice, a broad market stock index, just like the S&P 500, or the portfolios of all NYSE stocks is generally used, or in Germany, the DAX. By the way, the DAX inherits roughly 80% of the German market capitalization. So it is very, very representative for the German stock market, although only 30 stock titles are in there. Historically, the market risk premium has about 6.5 to 7 above the return on treasury bonds, so RM minus RF is 6.5 minus 7. And this is very much in line with the recommendations of Institut der Wirtschaftsprüfer in Germany, who also calculate numbers around this on a regular basis. What are the takeaways of this video? The expected return is the cost of equity of a company, since it is the market's expectation. It can be easily derived using the security market line formula from the capital asset pricing model. It is the discount rate for every business valuation. Furthermore, it is the rate used to derive the WACC, which in turn is needed to assess investments inside the company. But keep in mind that the beta is still a levered beta or equity beta, since the stock or the company that we observe on the market is usually levered. It inherits bonds or debt finance. It needs some adjustment that we call unlevering to become an asset beta, and it can be relevered up again if you want to value a different company like a peer group company. I hope this video helps you. Thank you very much for listening and see you in the next video.